There are two invisible lines on your chart that market makers use as a kill zone. And the best part, they are drawn 24 hours in advance, and 90% of traders are completely blind to them. Today, I'm not just showing you these lines. I'm giving you the exact blueprint to see the smart money moves before they happen. Now, look at your chart. I bet you see indicators everywhere, all cluttering up your screen. But you know what's missing? The two most important levels on the entire chart, yesterday's high and low. Here's what blew my mind when I first discovered this. I was losing trade after trade, getting stopped out by a few pips, then watching price rocket in my favor. Then after a lot of backtest, I've realized that every level from yesterday is still alive today. I then switched markets, and I started marking these levels on the other charts, and I couldn't believe what I saw. Price would drop down, hit yesterday's low to the pip, and bounce. Or rally up, kiss yesterday's high, and reverse hard. It was like the market had memory, and that memory was exact. Most traders ignore these levels completely. They're hunting for the next hot indicator while missing the roadmap right in front of them. You're already ahead of them just by watching this. Let me show you what's really happening at these levels. It's not magic, it's psychology. Think about yesterday's high. That's the point where every buyer from that session got their best exit price. But it's also where every seller thought, I wish I'd sold here. Today, when price comes back to that level, both groups are watching. The buyers are thinking, should I take profits? The sellers are thinking, here's my second chance to short. This creates a battlefield, and battlefields create volatility. And here's the part most traders miss. Smart money knows this too. They position themselves right at these levels, waiting to capitalize on this emotion. Watch this example. Price approaches yesterday's high. You can almost feel the tension building. Most traders are debating whether to buy the breakout or short the resistance. Meanwhile, institutions are already positioned. And when that decision moment hits, boom, violent move. Game over for whoever guessed wrong. The speed of that rejection tells you everything. That's institutional size hitting the market. This is how the big boys think. They don't predict. They position and wait for small traders like you and me to walk into their trap. Now most traders stop here. They mark yesterday's levels and think they've got it figured out. But they're missing the multiplier effect. Volume weighted average price. Most people think it's just another line. But when you layer it with yesterday's levels, magic happens. Here's what I discovered by accident. I was short on a stock. Price dropped to yesterday's low, and I expected a bounce, but it kept falling. I was about to cut my loss when I noticed something. The lower band was sitting way below yesterday's low. No confluence, no support, just yesterday's low hanging out alone. That's when it clicked. One level might hold, but two levels in the same spot. That's a brick wall. This filter alone eliminates 70% of the fake signals because now I don't just trade levels, I trade confluence. Watch this setup. Price drops to yesterday's low. But look where the lower VWAP band is, right underneath it. Double support. The first bounce off this zone was violent, institutional buying. They saw the same confluence I did and loaded up. And here's where it gets interesting. That confluence doesn't just provide better entries, it gives you better exits too. Let me tell you about the worst trade of my career and how it taught me the most important lesson about these levels. Bitcoin was in a strong uptrend, higher highs, higher lows, textbook bull market. Then it pulled back to what looked like perfect support. That level was yesterday's low. I bought without hesitation, with a big position. Easy bounce trade, I thought. 30 minutes later, my stop got hit. But then something strange happened. Bitcoin reversed hard. That's when I realized my mistake. I wasn't wrong about the level. I was wrong about the setup. Institutions don't just respect these levels. They use them as weapons. They'll push price just far enough through a level to trigger all the stops, then reverse and go the other way. It's called a liquidity grab. And it happens at yesterday's levels more than anywhere else. The lesson: these levels work, but not always exactly where you think. You need to expect the hunt, not fight it. Now, when I see price approach yesterday's low, I don't just look for a bounce. I look for the trap first. Here's something that'll change how you see every chart. These levels don't just show you where price might turn. They show you what smart money is thinking. Look at this example. Price breaks below yesterday's low. Most retail traders see this and panic. Support is broken. Time to sell. But watch how the break happens. Is it slow and grinding, or violent and impulsive? This break was explosive. One massive red candle slicing through the level. That's not panic selling. That's institutional positioning. And institutions don't waste moves. When they push price through a level with that much force, they're not trying to scare you out. They're building a position. Here's the tell. After that violent break, price didn't keep falling. It consolidated just below the level, then reversed hard. Classic smart money pattern. Break the level to grab liquidity, then reverse and ride the real move. Most traders got stopped out on the break and missed the entire reversal. But once you know this pattern, you can trade with the smart money instead of against them. The key is reading the footprints they leave behind. Violence means institutional interest. Chop means confusion. Now let me show you where this system becomes a money printer. Ranging markets. Most traders hate ranges. They can't figure out direction, so they sit on the sidelines. But ranges are where yesterday's levels shine brightest. Watch this market. For 3 days straight, it bounced between yesterday's high and low like a pinball. Touch the high, reject. Touch the low, bounce. This is mechanical trading at its finest. You don't need to predict anything. The market tells you exactly what it's going to do. My process is simple. Mark yesterday's high and low. Wait for price to approach either level. Look for VWAP confluence. Trade the bounce with stops just outside both levels. In this chart, price dropped to yesterday's low and hit the lower VWAP band at the same spot. Double confluence. I went long immediately. Stop below both levels. The target was yesterday's high. And the bounce worked, not because I'm smart, but because big players were positioned the same way. When that much support lines up in one spot, the market has no choice but to respect it. But what happens when these levels break? How do you know if it's real or fake? Here's the secret most traders never learn. Real breakouts don't hesitate. Fake breakouts do. Watch this example. Price breaks above yesterday's high. Looks bullish. But check out what happens next. Instead of accelerating away, price starts chopping around just above the level. It's struggling, fighting for every pip. That struggle tells you everything. If smart money was behind this breakout, price would be flying. The fact that it's grinding means institutions are fading. Compare that to this breakout. Price hits yesterday's high and explodes higher. No hesitation, no chop, just pure momentum. That's institutional buying. When they want to break a level, they don't mess around. And here's the advanced read. Even real breakouts come back to test the level. The difference is how they test it. Real breakouts come back and bounce immediately. The old resistance becomes new support. Fake breakouts come back and slice right through like the level never mattered. This retest is where the real money gets made. because you get to enter a breakout trade at yesterday's level instead of chasing it 20 pips higher. Now let's talk about what happens when VWAP bands line up with yesterday's levels. This is where the system becomes unstoppable. VWAP isn't static like yesterday's levels. It moves with price, creating dynamic support and resistance zones. When these zones overlap with yesterday's levels, you get confluence that's almost impossible to break. Here's how I trade it. Price approaches yesterday's low. I check where the lower band is. If they're close, I wait. If they're on top of each other, I load up. This setup gave me a 4-to-1 winner last week. Price dropped to yesterday's low and bounced off the lower band. Now here's what most beginners get wrong about VWAP. They treat it like a moving average. That's amateur hour. But smart money uses the bands as dynamic levels. The upper band becomes resistance in ranges. The lower band becomes support. And the middle line, that's the equilibrium. When price is above the middle line, institutions are net long. Below it, net short. This gives you the market's true bias, not just price direction. And when these bands align with yesterday's levels, that's when you get high probability moves. Here's the complete system that puts everything together. This is what separates profitable traders from everyone else. Step 1. Mark yesterday's high and low. These are your primary levels. Step 2. Add VWAP with standard deviation bands. Look for overlap with yesterday's levels. Step 3. Identify the market structure. Is it trending up, down, or ranging? In trends, fade moves back to yesterday's levels. In ranges, trade the bounces. Watch for liquidity grabs. Expect price to hunt stops just beyond the levels before reversing. Use the opposite level as your target. This gives you natural profit-taking points. This system works because it's based on 3 pillars: psychology, structure, and flow. Psychology from yesterday's levels, structure from VWAP, flow from reading institutional footprints. Most traders focus on just one pillar, like direction. But direction is just one piece of the puzzle. Smart money focuses on all 3. Where will traders place their stops? Where are the natural profit-taking levels? What's the path of least resistance? When you start thinking like this, trading becomes less about prediction and more about positioning. Let me show you exactly how I use this system. Tesla gapped down at the open, right into yesterday's low. Most traders saw this as bearish gap and go, but I saw something different. The gap brought price directly to yesterday's low and the lower VWAP band. Perfect confluence for a bounce. Someone with size was positioning for a reversal. I went long at the confluence zone, stop just below both levels, and target at yesterday's high. The best part was that I knew my max risk from the start. If both levels failed, the structure was broken and I'd take my small loss. But when confluence holds, the rewards are massive. This is what consistency looks like. Not winning every trade, but having a massive edge when you're right. Before you start using this system, let me save you from the mistakes that cost me thousands. Mistake number 1, trading every level. Not all yesterday's levels are created equal. You also want volume at the level. You want confluence with VWAP. You want institutional footprints. Random highs and lows from low volume sessions. Skip them. Mistake number 2 is ignoring the liquidity hunt. These levels are magnets for stop hunting. Expect price to push just beyond them before reversing. I used to place my stops exactly at yesterday's levels. Big mistake. Now I give them room to breathe. Mistake number 3 is forgetting about time. These levels are strongest in the first few hours of the session. By afternoon, their power starts to fade. Mistake number 4. Overcomplicating the setup. This system works because it's simple. Don't add 5 more indicators and ruin it. The market respects simplicity. Complex systems break down when you need them most. You now have a complete framework that puts you inside the minds of market makers. You understand that yesterday's levels aren't just lines on a chart. They're psychological battlegrounds. You know that VWAP confluence multiplies the power of these levels exponentially. You can read the footprints and distinguish between smart money positioning and retail emotion. You have a mechanical system for ranges and a dynamic approach for trends. This isn't just another trading strategy. It's a complete shift in how you see market structure. And if you're ready to fit this into a full A to Z trading system, that's what our academy is for. Link is in the description.